Hello, this is Lauren Goodwin, Chief Market Strategist at New York Life Investments, and I'm here bringing you the US Chronicles, insights about the 2024 US election from an American perspective. It's Friday, November 8th, and now that the dust has settled a bit on Election Day, there are a few topics I think are worth sharing. As I mentioned in my last video, the magnitude of Republicans' victory in this election is important for policy ahead. Key areas of potential change, like trade, immigration, tax, and regulation, are already unfolding in the markets. And it's typical for markets to have a knee-jerk reaction to such a decisive victory, but we're already seeing some of those trades rolled back as investors consider the nuances of policy change. Here's some of the debates we see the most. First, even though policy interest rates are moving lower, the Fed cut 25 basis points in its meeting yesterday, market interest rates have been moving higher since the odds of a red sweep started rising about a month ago. The markets doubled down on that theme when the red sweep materialized this week. Expectations here are for extended tax cuts, which support higher growth and stickier inflation that we've seen, but also more treasury issuance, creating a higher term premium or expected return for investors to hold that debt. Our investment teams in the US are suggesting that there's a bit of a bond vigilante activity in the marketplace, meaning that bond investors are concerned about how an already large deficit is not likely to get much smaller. This shapes investors' views about tax cuts. Both the Democratic and Republican Party suggested that extending the individual provisions of the 2017 Tax Cuts and Jobs Act, at least for the middle class, was likely. So we expect those individual provisions to be passed forward. But many investors outside the US have asked and assumed that the red sweep also means the corporate tax cut would be passed as well. We're less certain about this. Though there's not very much near-term political obstacle to lowering corporate tax rates further, there may be a bond market resistance via higher yields. Now, let's take a look at some of the other market moves. We've seen dollar strength against most other currencies, which we believe makes sense, at least for now. A stronger US growth and interest rate outlook relative to other countries tends to strengthen the US dollar, and concerns about tariffs are also likely playing a role here. Small caps have also seen one of their largest rallies in decades, likely as a result of stronger growth impulse and also hopes of the corporate tax cut, which have tended to benefit small caps more. We're less convinced that this is durable, in part because we're less convinced that the tax cuts will happen for corporations, and also in part because we still expect US growth to slow over the course of 2025, albeit from a very high base of about 3.5% real GDP growth in Q3 of this year. That can still be a good backdrop for small caps, but perhaps the bet over the last couple of days has been outsized. But keep in mind, again, the economic growth and earnings backdrop in the US is still quite strong, which gives the policy environment a bit of ballast, a bit of support to unfold in the coming months and quarters. We're therefore constructive on US equities and credit until the normal economic cycle shows a stronger or clearer signs of slowdown. So far, nowhere in the markets just yet.